Welcome back. In our previous discussion, we explored some of the key product innovations in microfinance. How micro insurance, micro pensions, group lending models, micro leasing, and housing microfinance have adopted to meet the unique needs of low-income individuals and communities. Each of these innovations offers valuable support, whether by providing financial protection, enabling savings, or creating customized solutions for specific industries. They are empowering millions around the world to build more secure futures. Today, we are shifting our focus to delivery mechanisms in microfinance. The methods through which these vital financial services reach underserved populations. These mechanisms have evolved significantly, moving from traditional in-person interactions to dynamic technology-driven approaches that enhance accessibility, speed, and efficiency. Historically, microfinance relied on physical branches and community meetings, often requiring individuals to travel long distances to access financial services. But with rapid advancements in technology and innovative outreach strategies, delivery methods have transformed, making it easier than ever for low-income individuals to engage with microfinance. In this video, we will explore the key delivery mechanisms in microfinance, including traditional branch-based models, mobile banking, agent banking, digital platforms, self-groups, and cooperatives. We will also examine their benefits, challenges, and future trends. Let's begin by looking at the traditional branch-based model, the original way of microfinance institutions. This model laid the groundwork for microfinance by establishing small branches or offices directly in rural areas, allowing institutions to be close to the communities they aim to serve. Here, clients could visit their local branch to apply for loans, make repayments, and access savings accounts or insurance, all within a familiar setting. Features of the branch-based bank: building trust and relationships. In this model, loan officers often visited nearby communities to introduce individuals to various financial products and services. These face-to-face interactions were essential. Not only did they build trust, but they also enabled loan officers to understand each client's unique financial needs and capabilities on a personal level. The relationship fostered through in-person meetings allowed MFIs to establish a strong connection with their clients, creating a reliable, community-focused network. Let's look into some of the benefits of the branch-based model. Personalized and accessible financial services. One of the standout benefits of this approach was the personalized service clients received. These in-person interactions ensured that products were well explained, addressing any questions clients had, especially important in communities with low literacy rates. Loan officers could guide clients step by step, often offering financial education alongside product information. This focus on education meant that clients were better prepared for success as they understood not only the product but also how to manage it efficiently within their financial situation. Let's look into some of the challenges of branch-based model. High costs and limited reach. While the branch-based model had many advantages, it also faced significant challenges. High operational costs became a major obstacle. Setting up branches in remote areas, regularly deploying loan officers, and maintaining infrastructure was resource intensive. For MFIs, these costs limited how widely they could expand, meaning that not everyone who needed these services could access them. Despite its effectiveness in building relationships, the branch-based model required substantial investment in both infrastructure and staff, making it difficult to scale and reach larger populations. Bridging tradition and innovation. As we see, the traditional branch-based model has strengths in relationship building and trust, but its limitations is scalability and cost effectiveness have led to the development of new delivery mechanisms in microfinance. By adopting traditional methods to today's technological advancements, MFIs can expand their reach while retaining the personalized touch that clients value. As we move forward, let's explore how these newer models are evolving to blend these strengths with modern efficiencies. This foundation helps us understand why innovations in delivery mechanisms are so very essential. They allow microfinance to reach more people more efficiently without sacrificing the trust and connection established in these every branch-based models. Let's look into agent banking, expanding access through local agents. In this setup, agents act as intermediaries between the MFIs and the clients. Imagine walking into the local shop and being able to make a deposit, withdraw cash, or even apply for a loan, all with the assistance of the trusted local agent. These agents offer clients a familiar face and a nearby option for basic banking services, eliminating the need to travel to a distant branch. This is especially important for individuals in remote areas, as it makes financial services more accessible and convenient. Now let's look into some of the benefits of agent banking. Agent banking offers several advantages. It expands the reach of MFIs by leveraging existing networks of local businesses, reducing the need for physical branches. Agents provide a familiar face in the community, which helps build trust with clients. For clients, agent banking reduces travel costs and time, making it easier to access financial services. Let's look into some of the challenges of agent banking. While agent banking offers significant benefits, it also presents challenges. One key risk is the potential for agent misconduct or fraud, which can damage the reputation of the MFI. Additionally, agents are often limited to the range of services they can offer. More complex services, such as loan approvals or financial counseling, usually require the involvement of a branch. Future trends in agent banking. The future of agent banking will likely see greater integration with digital platforms. Agents could be equipped with mobile devices connected directly to the MFI systems, enabling real-time transactions and more sophisticated services. As digital financial services grow, agents may also play a role in onboarding clients to mobile wallets and guiding them through digital banking. Now let's look into digital platforms, the future of microfinance delivery mechanisms. Digital platforms have become a transformative force in microfinance, enabling clients to access financial services through mobile apps, online platforms, and digital wallets. These platforms significantly reduce the need for physical infrastructure while expanding the reach of microfinance services. There are several types of digital platforms in microfinance, including peer-to-peer, that is P2P lending platforms. These platforms connect borrowers directly with lenders, bypassing traditional financial institutions. Platforms like Kiva allow individuals to secure microloans from a larger pool of lenders. Crowdfunding platforms. Similar to P2P lending, crowdfunding platforms enable borrowers to raise funds for projects through small contributions from multiple individuals, making it easier for entrepreneurs in emerging markets to access credit. Next, digital loan management systems. These platforms help MFIs manage loan portfolios, automate bank office processes, and as well assess borrowers' credit risk more accurately using data analytics. Let's look into some of the benefits of digital platforms. Digital platforms offer several key benefits. They make financial services more accessible, allowing individuals in remote areas to apply for loans or make payments from their mobile phones. For MFIs, digital platforms reduce operational costs and offer valuable data-driven insights to improve credit scoring and lending decisions. Now let's look into some of the challenges of digital platforms. However, digital platforms face challenges, particularly in the areas with low digital literacy or even poor internet connectivity. Additionally, the risk of cybersecurity threats and fraud requires strong security measures to protect both the clients and the institutions. Future trends in digital platforms. The future of digital platforms is promising. Advancements in artificial intelligence, commonly known as AI, will enhance credit assessments, while blockchain technology will improve transparency and security in financial transactions. These innovations will continue to drive financial inclusion, offering a more integrated and holistic approach to delivering financial services. Next, let's look into self-help groups, SHGs, a community-driven delivery model. Self-help groups are grassroots community-based groups that pool their savings to provide microloans to members. SHGs often meet regularly to manage financial matters, fostering peer support and accountability among the group members. Let's look into some of the benefits of SHGs. SHGs offer several benefits including peer support. Members of SHGs hold each other accountable for repayments, reducing the risk of defaults. Then, women empowerment. SHGs have been particularly effective in empowering women, offering them access to financial services, leadership opportunities, and social networks. Let's look into financial literacy. Participation in SHGs help improve financial literacy by teaching members about savings, budgeting, and even managing loans. There are certain challenges of SHGs. Despite all these benefits, SHGs face challenges. The success of an SHG depends on the cooperation and trust among its members. Disputes or defaults can undermine the group's effectiveness. Additionally, SHGs often offer small-scale loans, which may not meet the needs of members seeking larger financial support. Next, cooperatives, a collective approach to financial services. Cooperatives are member-owned financial institutions that provide savings, credit, and other services to their members. Members pool resources to offer financial services, and profits are either reinvested or distributed among the members. Let's look into some of the benefits of cooperatives. Cooperatives offer tailored financial products that meet the needs of their members, promoting economic empowerment and financial inclusion. Because cooperatives are community-driven, they are often more sustainable and resilient, fostering a sense of ownership and accountability among the members. Let's look into some of the challenges of cooperatives. However, poor governance or limited access to capital can hinder the success of cooperatives. Effective leadership and transparency are very much essential for maintaining the long-term success of cooperatives. Therefore, to conclude, from traditional branch-based models to digital platforms, agent banking and community-driven mechanisms like SHGs and cooperatives, the delivery mechanisms in microfinance have evolved to meet the diverse needs of low-income populations. As technology continues to advance, these delivery models will integrate digital tools and drive the microfinance sector forward, fostering economic empowerment and helping to reduce poverty on a global scale. Thank you, and stay tuned and stay connected.